So it's been a mixed session on the street. We raced early losses, uplifting remarks from Dr. Fauci, glimmers of hope on social distancing, and then there was that March consumer confidence report, much better than anticipated. But then later on, it was the news conference. Governor Cuomo and other governors out there giving us sober reminders of the current circumstances. So how should investors approach this market? Joining me now, Bull Tick Capital Markets Chief Strategist Kathryn Rooney Vera, along with Divine Capital CEO Danny Hughes. Kathryn Rooney Vera, let me start with you. We're less volatile right now. You could argue if the Dow was off 1,000 or even 2,000 points, it might not be a big deal, all things considered. So in a way, it's a moral victory. But how do you navigate these new waters?
Well, Charles, no one can price the bottom. That's impossible. So those who divine that they can, it's just an impossibility. So what I've been suggesting to my clients, given that we are in a supreme bouts of volatility, is a very simple concept, Charles. It's dollar cost average in. It's be disciplined, and in a prudent and disciplined approach, increase your equity positions in the S&P 500 over a period of time. This is a bear market. We could very well get another leg down. This is not smooth sailing from here on out. Until we have a medical remedy, until we see new case count drop, we could be due for another bout to the downside. So I'm telling my clients, look, guys, every 2 weeks, take a portion of your cash position. It could be 10%, put it in the markets.
You know, Danny, one thing that's been working for me and my subscribers are buying on those big down days right at 350, right? And it's been pretty good, although I've turned a lot of long-term investors into short-term traders because, you get these bounces and you're up 20% on the stock or 25% because, to Kathryn's point, you think we can pull back, you take it off the table, and that's not how most investors want to go about this market. So what are you doing? How are you handling this?
It's so great to hear your voice, Charles, and it's great to see you back. I think Kathryn's right. I mean, March came in like a lion, and it's going out like a snowball. Although the consumer number was better than expected, it masked the true economic realities of a shutdown of most of the economic engine. I think that investors are way too excited about these down days. It shows me that maybe we haven't really hit reality yet. GDP is expected to contract by an annualized rate of somewhere between 15 and 30% in the second quarter. And what I like to call the snuggle industries, by which I mean the restaurants, air travel, concerts, shopping malls, tourism, they seem right now to be the most severely impacted. But to the entities servicing, lending, and borrowing from those industries, this next quarter it could be catastrophic.
Mm-hmm.
Yeah, it's going to be catastrophic for several industries. Kathryn, let me ask you about how you are reacting or how investors should react to news with respect to the coronavirus, because I think almost everyone agrees that the market will somehow sniff out really, really great news maybe weeks before we get the official all clear. Are you looking at daily new case volumes, death numbers? Are you looking at how the curve is starting to bend in certain areas? Because every morning I get up, I do that. I begin in Asia, I look at the European data, and then I start to focus on America's data. And it feels like days we get some pretty good news, it's been reflected in the market.
Yeah, sure. No, you're right. I think it is new case count every day, Charles. And of course, it's any advances in terms of medical remedy, in terms of, improving current conditions or a vaccine for future cases. But what I look at in terms of economic numbers is consumer confidence. It came out surprisingly well in March. That tells me that 1Q, first quarter of 2020, doesn't have to be negative. So we could get a tragic collapse in 2Q. I think it's going to be 25% quarter on quarter. If the first quarter growth, because consumption remains strong and consumer confidence really was resilient, Charles, I think you could get a positive first quarter, a devastating second quarter, and then likely a third quarter as well negative for a rebound in the final quarter or the beginning of 2021.
And Danny, a lot of people are expecting that. And for the audience, they should understand that there's always been this notion that economies and stock markets are like rubber bands. They're elastic. So the further back you stretch it and you let it go, the quicker it rebounds. Of course, you can stretch it to the point where it pops, Danny, but are you looking at for this bounce, this sort of elasticity to the economy, to the stock market, anytime in the second half?
Well, going into this, we had I won't say a roaring economy, but we had a really strong economy coming into this coronavirus situation. So I do expect to see the consumer and industry and banking actually rebound pretty nicely once we get the all clear, which I don't believe we're necessarily close to yet. But what this has done is it's kind of changed our mindset into becoming much less of a buy and hold and like wait it out for forever to a trading, like you said, Charles, where we've got to just be much more active in the markets. And this is where I come from. I was a market maker for 20 years, so this is my kind of market, and I love it. And I hate to see this devastation, so I do not want to take away from that. But this kind of dislocation that we're seeing from the standpoint of pricing in equities and in bonds that has absolutely no connection to what's happening in reality, this is going to continue. And this is where, if you are very, very focused on the end game, which is creating positions over the long term, this is where you make your money.
Charles, can I jump in there,
Kathryn
Charles?
Rooney Vera, I got to let you go. I'm sorry. I love both of you, but we got to move on, and I appreciate your expertise. But